Anytime the Fed chair speaks, the market listens closely for clues about future interest rates or economic conditions. JP Morgan identifies three key structural damage channels. If this shift continues, the downside targets for the euro would be. Welcome to this week's market breakdown. I'm Isaac Martinez, trader and market analyst at xChief. In today's video, we'll dive into the key macroeconomic events shaking the markets and conduct in-depth technical analysis on the dollar index, SP500, Euro USD, and Bitcoin. With tariffs, inflation, and policy shifts all in play, now more than ever, it's crucial to position with clarity. Let's decode what's next together. Let's start with the economic calendar. The hours you are going to see right now are based on GMT -5, based on the New York trading session. This week brings a lot of important economic data that could move the market. On Tuesday at 7:30 a.m., we have the core CPI, regular CPI, and CPI year over year. These are key inflation numbers that show how many prices are changing. If inflation is hotter than expected, it can affect interest rate decisions and shake up markets. Then, on Thursday at 7:30 a.m., we'll get core PPI, core retail sales, PPI, retail sales, and unemployment claims. This is a big cluster of reports. PPI tells us how much prices are changing for producers, while retail sales show how consumers are spending. Both are important signals for economic strength. Jobless claims help us understand how stable the job market is. Also on Thursday at 7:40 a.m., Fed Chair Jerome Powell is scheduled to speak. Anytime the Fed chair speaks, the market listens closely for clues about future interest rates or economic conditions. Be prepared for possible volatility. And on Friday at 9 a.m., we'll get preliminary numbers on consumer sentiment and inflation expectations from the University of Michigan. These help us understand how consumers are feeling about the economy and where they think prices are going. All of these events will be closely watched by traders and investors, and they could create important moves in the dollar, stocks, and even Bitcoin. Now let's continue with the most important fundamentals of the week. President Donald Trump remains confident that his stick and carrot tariff approach will launch the US economy into a new era of strength. But economists at JP Morgan are sounding the alarm, pointing to the UK's post-Brexit experience as a cautionary tale. While the UK avoided an immediate recession thanks to global economic momentum and prolonged trade negotiations with the European Union, the country still suffered a slow-burning internal shock that damaged long-term growth. Household consumption slowed, business investment collapsed, and labor productivity plummeted. JP Morgan identifies three key structural damage channels: a sharp decline in trade intensity, a fall in immigration that worsened labor shortages, and a multi-year drop in business investment. Specifically, the UK's trade in goods is now estimated to be 15% below where it would have been without Brexit. Manufacturing's share of GDP has shrunk to 9%. Investment lags behind US and Eurozone trends by about 15%, and productivity growth turned negative in recent years. The warning is clear. The US might be on track for a similar slow erosion. Even if a near-term recession is avoided, JP Morgan sees a long-term risk of weakening growth, declining investment, and stalled of productivity. While US officials promote current tariffs as the foundation of a new American revival, the data from the UK suggests that these types of policies often take a quiet toll over time, one that's hard to reverse once the damage is done. We continue with the technical analysis of the assets, starting as always with the strength of the dollar represented by the DXY index. Over the past week, we've seen bullish movements with a structure showing higher highs and higher lows, as we can see here. A clear upward structure based on this theory, and this suggests a possible upward trend. A key level we were watching was the breakout of the 100.2 276, which could signal a shift from the previous bearish structure that we have seen these last weeks to a bullish one, that is the one that we could be establishing right now. This potential change depends on developments this week, especially regarding the possible resolution of US-China tariff issues mentioned earlier. If these issues are resolved and support zones hold, the bullish trend could continue. Based on this scenario, upward targets for the week include the 101.585 level as a first objective, followed by 102.247. Another important price level is 103.534, and in the event of a strong bullish continuation driven by a tariff agreement, we could aim for 104.683 as a more distant target. On the bearish side, planned targets include 98.929 as the first bearish objective and 97.921 as a secondary level. Also consider the possibility of a bearish manipulation around 99.172 as a potential entry point for a bullish correction, so we can see a movement like this. A pullback, manipulation of this level, and then we can continue with this upward trend we were describing. Now let's move on to the SP 500. We've also seen a significant recovery in this asset, and it's important to understand the following. 5,786 level marks the last major high, the key point that needs to be broken in order to confirm a shift from the bearish structure we have seen with the SP 500, as we can see here. Only if we break above this level that we are mentioning, we can start to consider a sustainable bullish trend. Following a breakout of that level, we could set new targets, with the first one at 5,968 and a second one at 6,144 USD. A continued bullish move is highly likely, especially if the tariff issues are resolved as previously mentioned. However, if that resolution doesn't occur, or if something unexpected happens, such as an escalation in tariffs, for example, which is unlikely but possible, we could see a pullback in the SP 500. In that case, the first bearish target is clearly here, located at this fair value gap at 5,544 USD, followed by 5,433, then 5,324, and finally 5,186. While there are lower targets beyond these, like this point of the price or even this point of the price, it's unlikely we will reach them unless there's a very strong sell-off. In such a scenario, we need to break the key support at 4,835, which again remains an unlikely outcome at this point. Now turning to the Euro USD, we are in a scenario where, despite the recent recovery by the dollar, the euro remains strong. This suggests that we could still be within a bullish structure. I would set bullish targets at 1.13748 as the first level, followed by 1.1425. And finally, if we can keep this bullish momentum, we can reach 1.15732. However, if the dollar strengthens significantly, it's likely the euro will start to lose momentum, leading to the formation of a bearish structure. One key point to consider is the recent break below the 1.12642 zone, which is structurally significant. This level was considered a strong low, which is basically the point where we established a new higher high at this point. As you can see, we started the movement from this point and we reached the last higher high. So its break could indicate a shift from the bullish structure we've been discussing over the past few weeks to a bearish one. If this shift continues, the downside targets for the euro would be 1.1145, 1.1087, and 1.1011, all potential levels that could be reached this week. When it comes to Bitcoin, one of the best assets to gauge overall market sentiment, especially in the context of ongoing tariff conflicts. That's why we've seen strong bullish movements each time there's progress or resolution in these disputes. Recently, Bitcoin has surpassed all the targets we set last week. Just to remind you, we have established this bullish objective at 102,599 USD. If Bitcoin manages to hold above the $100,000 level, it is highly likely that it will continue its bullish momentum, potentially aiming for a new all-time high. For this, we need to shift to the daily chart and focus on the final resistance zones. The next bullish target would be at 106,159 USD, followed by 109,358 USD as the next and current all-time high. On the other hand, if you're looking at bearish scenarios, I can also highlight some potential liquidity zones. One clear level is around 93,793, and it's also possible that price could correct further to the 89,698 or even 86,175 USD. However, considering the current geopolitical context and overall market sentiment, a strong drop toward these lower zones appears unlikely at this time. While it's our responsibility to show you those levels, the most probable scenario remains a continuation of the bullish structure. If you found this analysis valuable, don't forget to like the video, subscribe to the channel and click the bell so you never miss an update. And if you are ready to take your trading to the next level, open your account now at xChief.com and access the markets with a trusted global broker. See you in the next session.